session of the series and the second session of the new year. Just to recap, our first session had James Callejas explaining how you can take advantage of 1031 exchanges to build wealth using investment properties. If you missed it or just want to watch it again, it is on my YouTube. Just scan this code to go to my channel, and I really appreciate having another subscriber. And to get all the updates on new listings and upcoming seminars, connect with me on WeChat by scanning this code here. Now that we are all caught up, I want to introduce our topic for this week, business structures and their implications. We will be discussing how to set up different entities, including S-Corps, C-Corps, LLCs, and more. The biggest reason people incorporate is to limit their liability. It allows them to protect their personal assets. There are also tax advantages for incorporating. This is a great topic for future business owners because you will be able to select the right type of corporation for your needs. It is also good for people who are buying an investment property and want to know about holding title as an entity. With that said, it's time to introduce our expert guests. This week, we have two guests, one to explain the legal implication and one to explain the tax implications. You may already know Bin Zhai. He's a CPA who has worked in some of the biggest public accounting firms in California. His specialties include tax planning and preparation and wealth management, which he has used to help grow small companies for the last 25 years. Since he's always one of our most popular speakers, we're excited to have him back. Joining Bin will be Mandy Lai from Maxstone Law. She's a seasoned corporate attorney with over a decade of experience in mergers and acquisitions, joint ventures, venture financing, and capital market transactions. She also advises numerous China-based conglomerates, investment groups, and venture capital funds in connection with their U.S. investment initiatives. Mandy will add a corporate and legal dimension to our discussion today. I know many of you are very savvy investors, but like to starting from the basics. Mandy, can you explain what an entity is and what are the reasons people create one entity like this? Hello, Mandy.
Hi, sure, Coco. Happy to be here. First of all, good evening and good morning, everyone. And it's my pleasure to be here today and to share with you today's discussion. And okay, let me show my screen first so that I can walk you through the my presentation. Sorry, can you see my screen? Oh.
Yes, yes.
Yeah. Can you see my screen now? It's on the presentation slide?
Not right now.
Okay.
Earlier, yes.
Okay.
Yeah.
Yeah.
Okay, great. So a very brief introduction of our firm. We are a corporate-based focused law firm, and we do lots of the mergers and acquisitions, and also venture financings and fund formations. I think we can start from this one. So a very frequent question that I encounter in our practices, people always ask me, so when should I set up an entity? Because as you know that you can do your own business without setting up an entity, theoretically speaking. But what's the best time to consider or set up the entity? There are several considerations. First of all, the tax is a big consideration, and I believe Bin will elaborate this topic later. And the other major consideration is the liability. So the direct answer is when you need to use the entity or use the new business to deal with the third parties, for example, you're going to sign a lease agreement, or you're going to sign a commercial supply or any agreement with the third parties, that's the time, at least before that, you need to set up the entity to isolate the liability of the entity from your personal liability. That's the biggest advantage of having an entity for the liability isolation. Yeah, and also you may also consider, whether you're going to represent your company by way of the personal introduction, or basically is by way of entity presentation. That also.
Yeah, Mu gave me some something, a key. I'm here to pick up something from Mu.
Oh, sorry, can you
Okay,
mute?
yeah, thank you.
Did you call them or?
Oh, I just talked to Mu.
Can you mute all the other audience?
Sure.
Okay.
Sorry about that.
No problem. So basically, it's the liability isolation function that determines when and whether you should set up your entity. And the next consideration, after you decide to set up your own entity, a question that you have to consider is, what type of entity should I set up? We have already heard about, people talking about the C-Corp, the S-Corp, and also you talk about the LLC, meaning a limited liability company. And then sometimes you will also hear about the limited partnership, or we say the law firm or some accounting firm, LLP. So those fancy names. But so you will ask, what kind of entities should I set up? The major considerations are very similar to the starting point. So first of all, you have to consider the tax implications, because the different entities have different tax considerations. So which Bin will also elaborate later. And from the legal perspective, liability perspective, we would say that C-Corp, S-Corp, and the LLC basically will protect you the limited liability, meaning that so long as you use these entities are duly formed and you use the entities to deal with the third party, then you are protected under the limited liability, meaning if just in worst cases, if the company is delinquent, then you don't have to pay the debt out of your own pocket. So that's the legal liability consideration. But for a general partnership, that's a different story. But I think probably we don't have to elaborate here, because for most business entities, the entrepreneurs here, the most common entity selection will be between the C-Corp, S-Corp, and LLC. And also from a legal perspective, the different entities will have different legal requirement for the entity to be operated. For example, for the corporation, it will have to be operated under a board of directors. But for LLC, it's much simpler. Basically, you can be managed, the manager managed or member managed. And after considering the type of entities, then the next question that you have to ask yourself is, so where should I incorporate those entities? Should I incorporate in California, or should I incorporate in Delaware, which is a very familiar jurisdiction that you will very often hear about, maybe from friends' recommendation, or definitely from lawyers. So you will ask, why should I? Why is a very natural question, like why most of the companies are incorporating in Delaware, even though their operations are not in Delaware. And a related question is, if I registered in Delaware, for example, and I operate in California, what are the extra costs for the entities to incorporate that way? And does that save any tax? Is it mainly for tax consideration or for other reasons? So that are all very natural questions that you will have to ask yourself. And here I just wanted to maybe touch upon a little bit about the jurisdiction selection from a legal perspective, that why people are people prefer to incorporate their entities in Delaware. That's not for tax reason, simply put. And because many people have the stereotype that, okay, I incorporate a company in Delaware, which may save tax. But the answer is no. Incorporating in Delaware generally will not save you any tax. Instead, it may increase your fees, which we can elaborate later. And the major reason for most of the entities incorporating Delaware is because two reasons. First of all, so because most of the U.S. companies are incorporated in Delaware, and as you know that the U.S. legal system are case law basis, so that Delaware corporate law has lots of the precedents and case laws. And the advantage of that is when people entered into any disputes or have any questions regarding, the shareholder relationship or the disputes between, for example, the directors and the shareholders, then you have lots of the case law to predict what outcome will be. So we say, generally we say the Delaware corporate law is very mature and has the certainty and predictability for business people to get a comfort of mind. That's the one reason. The other is Delaware corporate law generally are very flexible in terms of the corporate governance, meaning that it generally will allow the freedom of the parties of a contract to dictate the terms of the contract without too much, the regulations on the mandatory provisions that the parties will have to include, or without lots of the provisions that the parties of a contract cannot circumvent with the contractual arrangement. In that, so as you see that with that flexibility, especially lots of the in the venture financing context, the investors will require that the target company in which it intends to make the investment to incorporate in Delaware, so that they can make use of the advantages of the the relatively more flexible corporate governance to enforce the contract that they negotiate. That's the major reason. So still summary, I think the major takeaway is incorporating in Delaware doesn't save you any tax. It's mainly for corporate considerations. Next, we can quickly go through the the corporate governance structure for corporation, as I briefly touch upon, is the three layers: is shareholders, board of directors, and officers. So for corporations, the corporation by default is managed by the board. So if you have a corporation, then you cannot say, okay, I'm the CEO, and then I make it, or we say it's like a legal representative, which isn't the concept under the U.S. law. So you should, for every major decisions of the company, that has to be run by the board of directors, meaning the board has to either vote for that matter or give you a written resolution. That's the proper way to do that. And whether you do that properly, it depends on whether you can avail yourself of the the limited liability protection. That's very important. And since we talk about liabilities and everyone are very concerned about liabilities, we can use one slide to talk about the liabilities in general here. So basically for the shareholders, since we have the limited liability protection, so the shareholders have the, we say it's limited liability unless in very limited circumstances, the corporate veil has been pierced, meaning that if you, for example, even if you incorporate a company, but still you commingle your personal asset, your bank account with the company's bank account, and also you don't have the formalities I just mentioned, like the board resolutions, the officers, the three layers, then even if you have the corporate, then you still take the risk of not protecting by the limited liability. That's the shareholders. For the directors and officers, I think people need to pay attention to that. So being a director or an officer of a U.S. company will have potential risk, because under the U.S. law, the director and the officer have fiduciary duty. I think that's the term you'll always hear about. The director and officers have fiduciary duties to the company, own to the company, not own to a specific shareholder. For the fiduciary duty, meaning that you have a duty of care, which basically meaning that you have to make an informed decision. You have to work hard at a very minimum reasonable standard. But secondary, which is more important, is you have a duty of loyalty, meaning that you cannot have any like conflict of interest transaction, so that to damage the interest of the company and the shareholders, and you have to act in good faith. Being a director, sometimes people will just think, okay, some friend maybe invite you to be a director and officer of a company, but be careful that always bear in mind that it's good to be a director and officer, because you can help your friend, and you can also make contribution, but still bear in mind that may bring some liabilities if you fail to fulfill your duty of fiduciary duties. That's important. And third, I want to mention, because the directors and the officers have fiduciary duties, and accordingly, there may be some litigations risk regarding the failure to fulfill the fiduciary duty. So people will have certain mechanism for people to protect from the liabilities. The most common one is for D&O insurance. So more and more companies, especially the companies at a later stage, will buy the D&O insurance. Basically, the insurance will pay the amount that the director and officers have to pay in their capacity as a director, basically acting for the company, but subject to certain carve-outs. Especially those carve-outs are surrounding the situations in which there is a conflict of interest. So that's the D&O insurance. The takeaway is, if you are director and officer of the company, you may discuss with the company, the board of directors, to see whether a D&O insurance should be in place to protect your liability. So lastly, I think I'm going to very briefly talk about the major procedures and documentations. It should be straightforward. So for the C corporation and S corporation, namely, you have a certificate of incorporation or articles of incorporation, depending on the jurisdiction, and then you have EIN and have bylaws and internal documents. The internal documents, I mean, is a very important documents, meaning those documents that will determine or evidence who are the shareholders of the company, whether the directors are duly elected. Those documents, sometimes I need to mention this because in our practice, some people will feel that, okay, once I file the articles of incorporation, which is the one-pager to be filed with the secretary, then I'm done, the company is formed, so I have the company. But that's not true, because that's only only evidence that a company has been formed, but no one knows, and you cannot evidence that who is the shareholder of that company. So when the company is in dispute, when someone is going to dispute your shareholding, then you don't have any document to evidence your shareholding. So that's why you will have to have a set of internal documents, including the board resolutions for the issuance, the share purchase agreement, and the share certificate, a bunch of accompanying documents to evidence your shareholding. And also still, other than the the articles of the incorporation, also the internal documents, you have to pay attention to the regulatory filings, namely, I think the B13 BE filings, meaning if a foreign shareholder owns more than 10% voting power, then you have to make a filing under with the Department of Commerce. That filing some people always miss, and there may be consequences to do that. And also I want to mention, just briefly mention that there is a recent legislation, maybe you have heard about it. It is called the Corporate Transparency Act. So very soon, within this year, there will be a detailed implementation rules under which some companies, most of the small business companies registered in the US or foreign companies registered in the US will have to report their beneficiary shareholding upon formation and annually. So that, for now, you don't have to report your shareholding structure. As I said, the shareholding structure are purely internal document. But within this year, after the publication of that rule, the small business will have to report the shareholding upon formation and annually thereafter. So that's a new legislation that people will have to watch for. That's the corporation. And last thing, LLC. LLC is a very simple company in terms of formalities as compared to corporation. So basically, LLC is governed by Llc Operating Agreement. Basically, Llc Operating Agreement will, similar to the bylaw, will set forth how the company LLC is going to be managed, whether it's managed by the manager or whether it's managed by a member, and how the manager or the member is going to make the decision. So for LLC, in addition to the certificate of incorporation, which is also the one-pager you file with the Secretary of the State, you have to prepare the LLC Operating Agreement, which document I know that some people will just forget about it, but that's a very important document. Yeah, I think that's basically what I'm going to briefly, discuss with you today. Yeah, I'll give it back to Coco because I know like Bing will have very good discussion about the tax, which people are mostly focused on.
Thank you, Mandy. So towards the end, Mandy, you mentioned about the liabilities in general. Mr. Bin Zhai, since limiting your liability is the biggest reason people choose to incorporate, can you explain more about liabilities and asset protection? What are you protecting your personal assets from? So Bin, take it over, yeah.
Okay. Hi, Coco. Hi, everyone. Welcome back. Can you see my screen, Coco?
Not yet.
Not yet? Okay. Let me show. We have to learn how to share the screen then. Hold a second.
On the bottom, share screen, yeah.
Yeah, let me get over there. Which screen? Screen 2. How about now? Can you see the screen? You can see it? Okay, cool. All right. Sure. So hi, my name is Bin Zhai. I'm very privileged to get invited to Coco's event again. And this topic is always on my client's mind. And I also very appreciate I have Mandy can join us. She is very busy, and I'm so happy she can talk about all the legal issues. I'm answered a lot of questions for my client too, So I'm gonna switch the topic to the tax impact on the business entity formation. So to follow Mandy's topic, I just basically want to show the assets protection needs among our client. A lot of my clients start with an individual to filing the tax return, and through their careers, they want to have their own business. They don't want to work for the big corporation or small corporation. They want to have their own business. So, and they talk to us, how can I do that? We always refer them to understand the concept of incorporation. Normally, I just use a very lame term to tell my client, when you have 3 needs in your business, you probably need to talk to the attorney or a CPA to think about a serious consider if you need business to protect you. The 3 needs is if you have an employer, if you have an employee, the employer always is always liable for the employee's wrong acts. And if you have a partner to join with you to venture in the business, and if you are if you are a general partner, like you are not incorporated, and whoever have a deepest pocket gonna liable for everything left. So you gonna liable by your home assets, your car, your bank deposit. None of a businessman want to see it because the business venture is already risky enough, you know. So and also if you have anything related, so if you have a vendor or supplier, you're probably going to create the product liability or the environment liability things like that. So when you have anything deal with the employee, supplier, or vendor in your business, you need to think about it to incorporate your business. So the primary reason is not really for save tax, as Mandy already mentioned. The corporate law can protect your limited liability. In California, that is doing through the California state, particularly the Secretary of State, and the attorney or legal counsel can help you to form the corporation. And its goal is to protect anything you own outside your business. They don't backfire to your assets you're working so hard to accumulate. Okay, so incorporate to also provide other protection like continuity in the event of death. If the owner died, the corporation can still conduct the business inside the corporation. They don't have to die with the sole proprietorship or general partner, and also they have a centralized management to conduct the operation. And the other various form of investment, they have a benefit. People already see the capitalism is a growth through the common stock, and on the stock market, they can value your assets value, your investment value. And there's a variety of other preferred stock and to have the return. And if you invest through the debt, it's also debt financing is also provide a lot of funding for your business. Okay, so let's switch to the other part. I always got to ask the question from my client. So within so many corporations, basically I try to see on the tax wise, I try to analyze the table over here to explain what's the main pros and cons for the corporation and the LLC. Okay, so this is another. So basically, at the bottom, all three C corporation, S corporation, and the LLC, they all provide the limited liability. And
Bino cannot see your table.
You cannot see.
Yeah,
okay.
yeah. Here we go.
All right. I have other part. Okay, so the table is over here, and the limited liability is really for the purpose is incorporate. What is a C corporation? What is a S corporation? This is really determined by the IRS code. On the IRS subchapter C is for the C corporation. They have another subchapter is for the S for the S corporation. And the S corporation was created because a lot of small business owner is really bothered with the double taxation. When you have a corporation, that the corporate is a tax entity. So their disadvantage is on the tax side. You first need to pay the tax on the revenue earned by the business. So they tax at the first run. When you issue the dividend, they will tax on the second run. So the same $100 they can tax as a pure revenue. You need to pay $21 for the corporate tax. Then if you decided to issue the dividend for the remaining $79, you're gonna pay the tax on the dividend again, although on the different rate, but you pay tax twice. So RS come out another chapter called the S-Corporation. They limited the tax. They said S-Corporation, they are not a tax entity. They are merely the reporting entity for the business. You just need to show how much you make on the S-Corporation, but all the income will pass through the K-1 form to everyone. You only pay tax once at the individual level. So that's why a lot of a small business, particularly is a close-held business, they are either S corporation or LLC. LLC has the same characters like S corporation, because the LLC itself doesn't pay too much tax, but or pay the income tax through its owner. But I have to remind you, in California, LLC do charge different tax. They have one thing called the LLC fee. When your revenue income, when you gross revenue over $250,000, you're gonna pay the LLC fee. That's another layer fee you have to pay to the California state. So unless you are really know, so we normally don't suggest the trading business to use LLC unless you really think you want to use LLC. I will talk about the other way to consider LLC later on. But just like Mandy said, the LLC is easy to bring member in and out. You know, you don't need to do a lot of formal documentation like issue the stock like C or S corporation. Okay, and the S corporation has a one advantage people really want to know is if you don't pay anything you earned from the business can be paid by either through the W-2 or through the K-1 income. The K-1 income has one benefit. They don't have to pay the Social Security, only the W-2 has. So S corporation compared to the C corporation, it's avoid the double tax. Compared to the LLC, it can save some Social Security tax. That's probably why there's a high percentage among our client, and a lot of the other CPA I talk about, they choose S corporation for their business. Okay, so another one is what's the tax benefit for incorporation? One thing is if your individual have a very high tax rate, and it is very common in the Bay Area here, normal engineer, double income, your tax rate could be way over 30%. But in the corporation, if you make income in the corporation, their flat rate tax so far is only 21%. So corporate tend to be pay lower tax sometimes than your individual. And also, a lot of my small business, they even have a benefit to have a C corporation is they can redirect their income to some tax-free fringing benefit, like RRS allow you to set up a group term life insurance, the company group health insurance, disability insurance, the medical reimbursement plan, like HRA plan and the RRS code 105, and the pension plan, like those defined benefit plan, and the profit sharing, like 401k plan. You know, all those are fully tax deductible. And a lot of like profit sharing plan and the pension plan, you don't need to pay the Social Security, and they all been tax exempt from the corporate. So you can save tax really quick. And also the C corporation also adopt the fiscal year. That means you don't have to close your year in the December year end. Your CPA gets very busy if all the company was do their year end tax filing, accounting closing, and the December. Some business can close in any month other than December. So you can spread out your workload, you know, and you don't have to, issued all the benefit at the year end, you can have them all year long to give the benefit to your employee. And the S corporation pass through income, as I said, if the owner can pay themselves already enough or their employee already enough, anything left in the company only pay the income tax. They don't have to pay the Social Security anymore. So that part can save a little bit of tax too through the incorporation. And we're also going to talk about the main difference between the double tax and the pass-through. As I mentioned before, a lot of a business, when they incorporate, they are automatically a C corporation. Okay, so that is given by default. You know, all the business start as a corporation, unless you don't want to pay the double tax, because under the C corporation, the corporation itself are a tax entity. They are not need to filing tax. They also need to paying tax. So small business, when you start small, or you don't want to, you never want to have a goal to go IPO kind of stuff, you don't have to stay in the C corporation. And along the way, you can save the tax through the C corporation. And as a, I don't know if you know, I guess all the company they listed on the stock market, they are probably C corporation. They have a different class of a stock, or they have a preferred stock. But in the S corporation, as an IRS rule, you only have a one class of stock, only as a common stock. You can't have a preferred stock. You probably won't get too much stock option. So their capital structure is limited. But for a lot of close-held business, they don't really mind, you know. So their goal is to grow their business organically, you know, not through the funding. So the S corporation LLC, they probably better off to choose a S corporation or LLC. And also C and S corporation LLC, they only need to file the corporate tax return, but they pass through all their income to their shareholder, so they don't have a tax liability per se, you know. So and the next topic I want to talk about the corporate formality and the tax avoidance. You know, so Mandy already talked about how to keep the corporate veil. You don't want your corporate veil to be pierced. In the end, you don't have a corporate liability protection. So we always tell our client, you can't just incorporate that, but still run your business. You're like a sole proprietor business to commingle your fund, have no accounting, no record keeping. By the corporate law, you should supposed to have a financial statement every month. By the end of the year, your accountant will work at the financial statement. Otherwise, we won't be able to file the tax return from anything on a spreadsheet. You know, so you need to keep not only the legal wise, you need to keep the company formality. You also need to observe the financially. You know, so besides the holding the annual meeting, maintaining minutes, you also need to keep a formal accounting book and update the accounting information with the Secretary of State. That's all required by the law. And there are still some techniques to avoid paying tax legally, like to pay the maximum reasonable compensation to the C corporation. So if you want to go IPO, but you don't want to limit yourself to only one class of a stock, you can always, to avoid the double taxation through the well-paid compensation structure. You know, so anything you pay out through the W-2, they are deducted in the corporation side. So you can end up with a very little profit to be taxed by the corporation. And you also can structure some fringing benefit to executive to get those benefits to be excluded. So we normally help a client to design a tax-free fringing benefit. The or qualified plan. When accountants talk about the qualified plan, that means the business itself can claim the deduction, and the individual who get the benefit, they don't have to pay the tax for the benefit that they receive from the corporation. Those are allowed. There's a still certain way you can do those through the C corporation, and have a and also if you have a different type of a business, you're running the business, or you also want to do other business like buying the real estate, you probably can buy the real estate in the LLC and then lend the real estate to the corporation. So you can pay the rent to your LLC and to get the tax deduction on your rental. So those a lot of things can be structured through the tax analysis. And the last, I have a table over here. I don't want to go through everything over here in the detail, but I just want to help you. If you have a corporation, you need to pay 4 kinds different tax and the 2 kinds different fee. So I have a column over here, have a 1, 2, 3, 4, 5, 6. The first 4 are the different type of tax you need to pay. And every time I pull out the table over here, my potential client will be scared, why they have so many tax for a corporation. So my only answer is, if the corporation, that's just how IRS designed. The corporation needs to pay the corporate income tax, the payroll tax, the sales the use tax. Basically, this is a transferring type tax. The corporation doesn't have to pay it. Whoever buying the stuff paying it, and the property tax. So this is a so-called 4 big tax for the corporation to take care. They pay into the different federal government, state government, the county government, and the city government. And the city government normally get their fee to the city business license fee. Like in San Jose, who has the highest city fee, what I see in this South Bay here, it's almost $235 or somewhere, and they also tax on how many employee would you have, another $35 for every 3 to 5 employee. And the last one is the annual reporting fee you need to send to the Secretary of State. So basically, over here is the checklist we send to our client when we engage our client, to let them know there's a different types of tax you need to pay. You need to wear, it's some homework you need to do when you have a corporation. And every year there's a different fee. That's just a normal fee to do business, okay? So that's concluded all my slide content over here. And I just leave my WeChat group over here. We are in the tax season now. So if anyone want to contact us, have any question, you can have this code. This code will be effective to January 26. You can join our group to have a question answered over there to the tax questions. So Coco, I return back to you. That's
okay. Then maybe you can unshare for a moment. Yeah. Thank you so much, Bin and Mandy. Great information. Before we get into the Q&A, I want to announce that next week, attorney Michael Lee will return as the expert guest. You may remember his presentation in December about California Proposition 19. Tonight, Michael is teaching his law school students at Santa Clara University, but he was kind enough to film a preview of what he is going to be talking about. Let's play the clip.
Good evening, Coco and friends. It's great to be with you, and great to be with you again. As you will notice from the sort of light that we have here, I am unable to join you live tonight. I'm normally with you live for a little introduction, but unfortunately tonight I'm actually teaching my class at Santa Clara Law, so I'm able to be with you through the powers of technology. But I'm very excited about next week when I can join you live and tell you about 3 things that we're going to introduce. We're going to be talking about issues for real property owners, business owners, and investors regarding concerns about unexpected losses through lawsuits, taxes, or other risks due to COVID and the coronavirus. So we're going to talk about a few things. We're going to talk about the threats and risks you could face as a business owner or real estate owner or investor. We're going to talk about those kinds of risks and how we can mitigate the risks either through insurance, business structures, or other protection. We're going to talk about the options to protect your assets, and this is going to be a little bit of asset protection planning with business structures or the California exemption system. The exemption system is, of course, for a primary residence, but there are some other things you can do to exempt property and protect it in case there is a risk. But you always have to do it before the problem happens. We'll see why next week. And then the last thing we'll talk about is legacy planning and basically just a brief introduction about estate planning and a little bit about co-ownership. That's another area where you can have a problem if you own things together. You may have your plan in order, but does the person you own 50% of the property with as tenants in common, do they have their stuff in order? Because I see many cases where my stuff's in order, but then all of a sudden I'm dealing with the wife or brother or sister of the person I used to really like, who I own the property with. They didn't have their stuff in order. So we'll be talking about all of those things next week. I'll be joining you live instead of via the recording, though my office will be a little bit darker next Tuesday when I'm with you in the evening than today. It's bright and sunny with even a little plane coming in. So very nice to see you again. Look forward to next week, and we'll be together live. Take care. Bye-bye.
Wonderful. Michael knows that you all want to learn how to safeguard yourself and your assets. It's an especially hot topic in current times. That's why I call the next seminar Shields Up. I hope to see you all back next week. It's going to be a good one. Michael teaches the law students at Santa Clara University, but you'll be glad he's not going to charge you a tuition for what he's going to present to us. Okay, now it's our Q&A session. So I have some questions. Let's start with this one. How to add owner to a company to set up as an S-Corp?
Mandy, do you add owner is through the shareholder purchase agreement kind of things? Is that right?
Sorry, what's the question again?
Yeah, the question is how to add owner to S corporation, I think.
Oh, okay. I think it's similar to the C corporation. So basically, S corporation is a corporation from the legal perspective. It's just the tax, as being said, have certain different treatment as compared to the C corp. So for corporation, generally, you add a shareholder. That means there are basically 2 categories of situations in which you will have a change of shareholder. First category is the company will have issue more shares. The company issue more shares to a shareholder. By that means the company have new shareholder. And second category is we call it secondary transfer, meaning the company does not increase the shareholding, but instead the existing shareholder transfer a portion or entirely his or her shareholding to a new shareholder. So that also a situation in which the transfer, the new shareholder may come in. So for the first category, the new issuance, the company will have to, based on the company's bylaw and then the then existing shareholder agreement, you have to either the board consent or the shareholder consent, according to the requisite threshold provided in the shareholder agreements, if any. So basically, one is you need a board consent or shareholder consent to approve the new increase, and secondly, the company and the new shareholder will have to sign an agreement, the share purchase agreement, to document the new shareholding. And also, in more complicated situations, the new shareholders will have to join the shareholding agreement, and also in connection therewith, you have to renegotiate a shareholding agreement. And for the second category, is more straightforward. So basically, a major documentation will be the transferal, and the transferee will enter into a transfer agreement. And sometimes because the transfer may be restricted under the company's bylaw or other, the charter documents. So the transfer itself will have to get consent by the company, and also may have to receive the waiver of the right of first refusal or co-sale right of the shareholders. So then you will have to get certain, consent and waivers. So basically, it will be consent and certain documentation, and then lastly, those are housekeeping works, the updated certificates and the shareholding register maintained by the company internally.
Okay,
Yeah, I just want to add one point in the S corporation, since the question asked, the shareholder has to be the green card holder in the S corporation. So if you are not a green card holder, S corporation cannot be admitted to the shareholder, because it's a pass-through entity. They have to get a K1 to file the tax return. Otherwise, IRS cannot track the shareholder gonna pay the tax. They won't allow you to join the S corporation.
Okay. So the second question, how do you put LLC assets in the living trust?
LLC assets into the living trust. Basically, you need designate the LLC owner to be a trust, right, Mandy? I think that's how you do it.
Yeah, I don't do the trust, so I'm not an expert on this area.
Right. I saw attorney does that, is to make the LLC to be the owner of the LLC. So
that may be a question for next week. Maybe
you can talk to Michael Lee. He is an expert to do the trust and the will kind of stuff.
We'll save that question for next week. Yeah.
Sure.
Okay.
Yes.
So Sanjay said, in order to declare your single rental house as a safe harbor and claim QBI tax deduction, do you have to first need to register yourself as an LLC in California for California tax purposes?
No, they don't have to. No. So this is mainly a individual tax question, but you don't have to use LLC. No.
Okay. Next question from Chris. My question is regarding trade tax status and what's the best way to leverage this?
Trader tax status?
Trader tax status. Trader.
Oh, the active trader?
Maybe it's the active trader. Chris, do you
mean active? I think the question is ask individual. This is I don't know if we can go through the individual question here, individual related. Coco, maybe we should concentrate on the business side. But I just very quick to tell the trader business, you need to file a form called not a form, you need to get a petition from IRS under code 755 to get approval. IRS approval to be an active trader, then you can report it as an active trader. Otherwise, any trading you do are still capital in nature.
Okay.
All right. Yeah.
From Z, if we are Texas residents, can we use a Texas or Delaware LLC to hold a California investment property, or do we have to use a California LLC to hold this property?
this is a little complicated. If you have a
Very savvy investors here,
yeah,
huh?
very savvy, but I just stick to the rule. If I did anything wrong, Mandy, let me know, okay? Because I try to play something in front of an attorney. So mainly I tell my client, if you have a real estate, you should incorporate. If you want to hold your real estate in any state, you should create an LLC in that state, and that LLC can be held by any other entity. Okay, so we don't recommend to create a California incorporated business to incorporate in Texas to hold a California entity, because you probably anything wrong on your property, still you need to sue somebody in California court and not in the Texas court, right, Mandy? So anything wrong with your property, the property reside the state, they're gonna have a saying,
Okay.
Yeah, I think a related issue here is, even if you incorporate a Delaware LLC or California LLC, or Texas LLC, then I think for a California tax authority, the issue is whether you can still establish the tax nexus with the California state, meaning that whether the LLC, for example, the Delaware LLC, was still required to qualify. We say qualify, meaning you have to do a registration in California, so that you'll be still subject to California tax. That's not a issue that you can. I think anyone can give you yes or no. It's a totally factual analysis depending on how are you going to manage your property. Are the major managers still located in California? So basically, we say it's a nexus with the California state. So basically, it's a tax issue, but just I believe Bin can elaborate if he wants, but that's a very complicated issue.
Yeah, my recommendation is to hold your entity in the California, to create a California entity first, then use that entity owned by other state company,
Okay.
Yeah.
So there are quite a few people asked for slides for tonight. If you wish to get slides, you can email me at CocoTanGroup@gmail.com. Chris, you can go ahead, drop the email in the chat, and then you can email, and then we will collect the slides from our presenter and email to you after the seminar. From Ron, can we set up an LLC to hold title of our principal residence to work around Prop 19? There should be no property tax reassessment as long as there's no more than 50% ownership change. Who wants to take this question?
I think Michael Lee should take that.
Perfect. Let's
I
save
probably,
this for next week.
I don't have analysis for this. I've heard a lot of people talk about this, but we don't. Yeah, I don't see any. Yeah.
Okay. Yeah. Okay. So Chris, you can drop the email to the chat so people can email us as well. Yeah. From Megan, can you please ping Bin that his WeChat group? Oh, your WeChat group is over 200 members, so you cannot join. So Megan, you can go ahead add. I guess you can add me first, and then I can add you to Bin's chat.
Okay, somebody else. Yeah, I'm not the expert on that.
Such a large WeChat group.
Yeah, it's only 200, not that large compared to Coco.
Okay. Right. So next one is also a next week question. Will LLC be affected by Proposition 19 that's passed? So we're going to save this question for next week as well. Right. Next question, when do we send in the $800 annual fee? I guess it's for Bin, right?
Yeah, the annual fee, I have if I can share my chart over here. Normally is either I don't know how to share right now. Okay, so it's due in 3.5 months after your year end. So it's in the April 15th if you are calendar year. Okay, so if you are fiscal year, just add 3.5 months to your year end. That's 800 when it's due for the current year.
Okay. how to change a LLC to S-Corp. Is there a benefit for doing that? But I guess we already compared the LLC and the S-Corp. Isn't it a way to change it? Yeah.
Yeah, I didn't touch this topic. I think Mandy already mentioned the LLC is a much liberal format to incorporate. You don't need to observe too much things or have an attorney prepare too much document. So in the tax wise to LLC by IRS, you need to petition IRS to be taxed on the different way. So one thing, if you're really not sure, go to S corporation, C corporation, or still stay as LLC. You incorporate the LLC first, then filing a form called 8332. Your CPA should be able to file this, and you need to tell IRS, I want to be treated as a corporation, as a C corporation or S corporation. If you want the S corporation, you need to file another form to be elected as an S corporation. So technically it's doable, but just you need to get your CPA to do additional work for you, you know.
And also legally, you have to file a conversion forms to
Yes.
LLC to be a C Corp, and then plus tax forms. So basically,
I see.
For California, they under the Secretary of State website, it has a conversion forms for you to file.
Okay. Yeah.
Okay.
Sure.
Okay, next one. Regarding C Corp pays rent to LLC properties that's owned by shareholders, is triple net lease better or is a full service lease better?
I normally suggest triple net, you know, so have a tenant to pay the property tax, the utility kind of stuff, you know. The full service, you just need to add all those things on the inside of a rent, you know. Triple net means I give you the rent, you also need to responsible for something else, you know.
Okay. From Tito, LLC for limiting rental landlords liability. So what is a practical solution for 99% cases when you have a mortgage? Lenders never allow LLC as a borrower. Of course, you can do things behind the lender's back, like transfer to LLC after loan closing, but you will get stuck again when you try to do a refinance. So what's your suggestion?
Normally, I saw in the practical wise, when you get the loan, you need to yank the property out of a LLC, just like Tito said over here, then get it approved by the lender. Or you can work on lender, has a lender to review all your corporate document, have them to agree to see if they have an objection, you know. Normally, normally I saw the case, yes, the lender doesn't want to bother by the legal language over there. They want to only lend it to you. You are responsible for the credit score kind of things, you know, because LLC doesn't have a credit score, you know.
Yeah,
Okay.
and sometimes the lender will allow you to use LLC as a borrower, but with the condition that you personally will be guarantor, meaning that from a bank perspective, their their rights are protected, but still you can use you can make the advantage of the protection of the LLC for other liability related matters.
Okay.
Okay, great. All right, so we have reached the end of our seminar. We will end the recording here. I sincerely hope you learned something that you can put to use. If you're ready to go eat your dinner, remember to say thank you to Bean and Mandy before you leave. Or if you want, you can stay and chat. I want to hear about your comments and suggestions. And if our guest is staying around and you can still ask them questions, don't forget that Shields Up is next Tuesday. I will see all of you next Tuesday. Thank you.
Thank you.
Yeah, I'm gonna stay around. So
yeah, I probably can stay 5 to 10 minutes too.
Sometimes get to stay a long time, right? Yeah. So so anybody who wants the slides. I got a bunch of people asking for that, and then just email us at CocoTanGroup@gmail.com, and we'll definitely email you tonight. Mandy, you can email me your slides too. Actually, I have your slides. I have.
We already sent you our.
That's right. I emailed to all of them.